Next question. How do you determine unit economics pre-revenue? Let's figure out what unit economics usually pertains, but I'm going to expand it a little bit because not only is this question important for you and your pricing, how to talk to customers, sales, but also for investors. Investors are going to ask about your unit economics. Unit economics typically involves the term COGS, which is cost of goods sold. But there are other things such as overhead and other things included such as customer acquisition cost, lifetime value, net profit, which is what happens after you do all this stuff minus the overhead. Overhead is going to be questionable, etc. So you need to figure out what all pertains into your unit economics. And the first thing that you have to do is you have to create a financial model. That is the most important thing. You have to develop the financial model. That is your foundational piece to figure out unit economics. What is a financial model? A financial model is the baseline framework, the foundation of all your financial decisions. It involves, here's the price of our product, involves here's what we're spending on advertising, here's what sales commissions are, involves all those other things. And then finally, you can end up looking at a projection. But remember, you're pre-revenue. So your projections mean nothing. No investor will ever believe any of your projections pre-revenue. And that's the reason that any projection pre-revenue can look like an amazing hockey stick growth graph. They go, oh yeah, we're going to double every year. We're going to go completely up and to the right. And I see founders put that in their pitch decks, and investors, we roll our eyes and we go, there, nice try. We don't even believe whatsoever. So you don't want to look like an amateur that way, right? What you do want to do is build a financial model, and you want to show all the economics that are involved in the financial health of your company. And therefore, these financial models are all over the internet. In fact, I know someone who specializes in it, and he coaches founders on unit economics via financial model because they'll challenge your assumptions, because financial models are the place where you put your assumptions. We assume that if we spend $1,000 on advertising, paid ads, we're going to sell 1,000 customers and they're going to pay us $10 each and we're going to make $10,000. Therefore, our net is this, and you can examine that. The model is so important because guess what? Then you can say, well, guess what? If we double the cost because ads on LinkedIn, paid ads now have increased in costs, or we want to double down, this is how it affects our finances. That's how you do it. That's just simple as that. Then what you do is you can play around, and you can play around with pricing, and you can say, all right, based on our staff, all those things, that's our unit economics, and these are the margins. It's simple. And you run all the scenarios over and over again. You have to start with the financial model, because if not, you're just thinking pie in the sky. And that's what you do when you research pricing. Let's say that you're creating a SaaS platform and your competitors are charging $100 per user a month. I'm just using round number. And let's say that your offering is exactly the same as those competitors. You're offering the exact same set of features. You just do it better. Well, then you can make an assumption to go in at $80. We're going to go 20% under market in the beginning and then slowly price optimize to the point where we're charging $200 because it's better ROI. And that's a story investors are going to love to hear. Well, then you plug in $80 a month into your financial model and say, based on everything else that we have to spend and how much we've been learning, because you're battle testing your data, and this is what's going to happen. I don't have $100 a month to spend just to get that one customer. Now I'm upside down. If I was charging $100 a customer, I'd be at least breaking even. I'm simplifying. I'm being so reductive because it gets so much more complicated. And that's the value of a financial model. Is what happens is you can play around and you can jig those numbers. And so founders, if you are serious about raising money or going out in the market and building a sustainable company, you need to know your financial model. It's a reminder to me, reminder to everyone. And that's where you have to start as a baseline. And from there, if you've got that, unit economics is super easy because your cost of goods sold is like, these are materials, this is what the delivery fee is, this is what the storage is, transaction fees, cost of goods sold, bang, and then the calculation comes out. Financial models ahead for you. Get that foundation in. I hope that answers your question, but it's a good question, very important to ask. And like I said, I appreciate anybody even asking that, because this is one of the things that a lot of founders ignore and they don't talk about, and it bites them later in the tail, especially if you're trying to raise investors. That's it for this one. Like, comment, subscribe. Let me know what you think, and share this with other founders that might be struggling with unit economics and needs financial modeling advice. This is for them. I'll see you in the next question.